This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Thursday, July 30, 2026, and this is the New York pre-market. Now, let's get into it. The S&P 500 has shattered its own support, closing at $729.46, while the VIX sits stubbornly at 18.21. It is a textbook divergence. Equities are bleeding, but fear hasn't spiked. That silence is louder than any scream. We are operating in the shadow of yesterday's FOMC decision, but the real clock starts ticking today. At 8:30 a.m. Eastern, we get the GDP report and initial jobless claims. These numbers will tell us if the economy is slowing enough to force a hand or if growth remains stubbornly intact. Then, at midday, the PCE price index and personal income data arrive, the Fed's preferred inflation gauge. And finally, at 2:00 p.m., the Fed releases its updated dot plot and statement. That is the binary event.
The GDP and PCE data provide the backdrop, but the 2:00 p.m. FOMC statement is the trigger. We need to see if the language shifts from restrictive to anything hinting at flexibility. Until then, we are navigating blindfolded.
Here is the snapshot as of 9:20 ET. The sell-off is broad. SPY is down 1.54% at $729.46. The Nasdaq QQQ is worse off at $661.73, down 2.4%. The Dow Diamonds has taken a hit at $515.41, down 2.18%, and the Russell 2000 IWM is at $288.57, down 1.64%. Sector rotation is violent. The technology sector is leading the decline at minus 2.64%, while the healthcare sector is up 0.61%, and the energy sector is one of the few green lights at plus 1.88%.
Technically, SPY is sitting on a knife edge. It closed yesterday at $729.46, which is merely 36 cents above the July 29 intraday low of $729.10. We are essentially testing the floor of our 10-day range right now. If we lose that $729.10 handle, the structural integrity of this consolidation collapses.
And look at the breadth. It isn't just SPY. The technology sector, the engine of the last year, is down 2.64% pre-market and has lost 7.6% over the week. That is not a correction. That is a sector-wide deleveraging. The money isn't hiding in small caps. IWM is tracking SPY almost perfectly. This is systemic risk, not noise.
Three stories are moving capital today. First, Microsoft is up 9.6% pre-market on Pulse Point expansion news. Second, Alnylam Pharmaceuticals is crashing 20.8% after missing Q2 earnings, with reported earnings per share of $1.21 versus estimates. Third, MarketAxess is surging 29.8% on an unrelated legal investigation by Halper Seyde LLC. Let's parse the implications.
Let's talk about that Alnylam crash. A 20% drop in a healthcare name usually signals biotech sector stress, but here it's isolating. Meanwhile, energy is rallying. Why? Because investors are abandoning growth narratives entirely. They aren't chasing tech alpha, they are fleeing to the physical. The yield curve is flattening, and this kind of single-stock carnage in high-duration assets is the precursor to sector-wide repricing.
I disagree with the sector-wide doom on the tech front. Look at MSFT. It is gapping up nearly 10% on specific fundamental news. That is not a technical setup, that is a fundamental outlier. If you are looking at the technology sector basket as dead, you're missing the micro opportunities where earnings beats are still happening. My $735.98 resistance level on SPY is there precisely because strong names like MSFT can prop up the index momentarily.
But Grid, you're focusing on the exception, not the rule. The sentiment data shows that despite bullish headlines for NVDA and MSFT, the aggregate fear gauge for tech is deteriorating. The VIX is down 0.46 points to 18.21, while SPY falls 1.54%. Where is the hedging? It's gone. Retail traders are assuming this is a buy-the-dip moment because volatility is cheap, but the order flow suggests they are getting trapped. Let's drill down into that SPY level. Grid, walk us through the mechanics of that $729.10 threshold. If it breaks, where do we go?
It's a chain reaction. The 10-day range for SPY is $729.10 to $754.57. We are currently at the absolute bottom of that box. If price closes below $729.10, we invalidate the last 5 days of consolidation. The next logical resting place, based on previous consolidation floors, is the $725 psychological level. Conversely, any bounce back inside the range gets capped immediately at $735.98, which was the July 28 low. That is heavy supply.
And here's the fundamental friction. The market is trying to digest sticky inflation. CPI is at 3.46% and core PCE is at 3.41%. Both are well above the Fed's 2% target. The Fed funds rate is stuck at 3.63%. When you combine that monetary rigidity with SPY hovering at support, you get indecision. Traders are hesitant to bid because they know the FOMC statement later today could change the entire discount rate for future cash flows. That hesitation creates the thin liquidity that makes a break below $729.10 so easy.
Which brings me back to the VIX at 18.21. This is the danger. A volatile market doesn't mean high VIX, it means erratic direction. But right now, the low VIX is masking the gamma risk. If SPY breaks $729.10 without a corresponding spike in the VIX, dealers who sold puts at these levels will be forced to short futures to hedge, accelerating the downward move. We are looking at a potential gamma squeeze to the downside, not a soft landing.
I acknowledge the gamma risk, SPECTER, but my charts show that $725 is a deep drawdown. The probability distribution suggests a mean reversion bounce towards $735.98 is statistically more likely in the morning session before the 2:00 p.m. announcement. You're predicting a crash. I'm seeing a failed breakout attempt.
It's not about prediction, Grid. It's about positioning. The put/call ratio for SPY hasn't spiked yet. Usually, when support breaks, you see a surge in put buying. Right now, nobody is buying insurance. That complacency is what SPECTER is warning about. We are walking onto a live minefield without detonators. Let's shift gears to the NASDAQ. QQQ is at $661.73, down 2.4%. Grid, how does this compare technically to SPY?
Worse, QQQ is trading at $661.73, which is only 59 cents above its 10-day low of $661.14. It is virtually touching the floor. A break below $661 confirms a structural failure of the tech sector's recent price floor. Unlike SPY, which has some defensive anchors, QQQ is pure beta. There is nowhere to hide. The resistance cluster here is tight. Once you lose $661, the path of least resistance is vertical.
And fundamentally, it's a valuation problem. Megacap tech is priced for perfection in a higher for longer rate environment. When you look at the earnings estimates, companies are struggling to justify multiples when borrowing costs remain at 3.63%. The divergence I'm seeing is between the headlines and the balance sheets. NVDA has good news, but the sector ETF, the technology sector, is dragging down 2.64%. The market is voting with its wallet that the sector average is broken.
Exactly. The yield curve is flattening. The 10-year 2-year spread is at plus 0.45 basis points, trending flatter. Historically, when the curve flattens this aggressively while equities roll over, it's a recession signal. Tech is the most sensitive to long-term rates. If the yield curve continues to invert or flatten further, QQQ's current price isn't a discount. It's a fair value mark that assumes no further damage. Any additional yield shock pushes this lower.
I'm seeing the sentiment flip. Earlier this month, tech was the king of sentiment. Now, the fear and greed dynamic is shifting toward fear specifically for growth stocks. The volume profile on the downside in the technology sector is heavier than the upside attempts. Buyers are exhausted. While tech bleeds, energy is one of the few winners. The energy sector is up 1.88%. SPECTER, you flagged this earlier. Why is energy decoupling?
Because energy is the ultimate hedge against the narrative breaking. If the soft landing fails, inflation sticks and growth stalls. That is stagflation. Stagflation benefits commodities and hurts durables. The energy sector is rising not because oil demand is booming, but because capital is fleeing the duration risk of tech and cycling into tangible assets. It's a risk-off trade disguised as a gain.
Technically, the energy sector is showing relative strength, but don't mistake strength for immunity. It is trading against a backdrop of systemic weakness. If SPY breaks $729.10, the correlation between all sectors increases. Even the energy sector could feel a wave effect eventually, though it is lagging.
From a fundamentals standpoint, the energy sector is benefiting from specific commodity cycles separate from the macro rate anxiety. It's an isolated pocket of liquidity. But here's the catch. If the FOMC statement hints at aggressive tightening to crush inflation, even energy stocks could face multiple compression. It's a fragile lead.
So the takeaway is clear. Tech is breaking structure, energy is holding as a hedge, and the broader market is waiting for a catalyst that doesn't exist until 2:00 p.m.
Let's tie this together. Grid has identified that SPY is testing the $729.10 support, and QQQ is flirting with $661.14, both of which are critical 10-day lows. CIPHER reminds us that the fundamental backdrop, sticky PCE at 3.41% and a 3.63% Fed funds rate, provides no reason for bulls to step in preemptively. Pulse confirms that the lack of VIX expansion means the market is unhedged, and SPECTER warns that this complacency sets up a gamma squeeze if those support levels fail.
To summarize, SPY is perilously close to losing $729.10 support, QQQ is testing $661.14, and the VIX remains dangerously suppressed at 18.21. The FOMC statement at 2:00 p.m. is the only event capable of resolving this tension. We recommend maintaining strict cash discipline until the dust settles. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.